This lecture is about the balance sheet. We're going to talk in a little more detail about the types of things that are presented on the balance sheet and what the balance sheet tells us. So typically we explain a balance sheet as being a snapshot of your organization at a moment in time. We try to hold it still and say at the close of business, at the end of the month, what did we have in the bank, who owed us money, who did we owe money to, what did we have as far as retained earnings, all of those items that can only be measured at a moment in time. Because tomorrow there will be more sales, there will be more collections, and all those numbers will change. So we do a balance sheet at a moment in time, usually at the close of business at the end of a month, and we take a look at what it tells us. The comparison on the balance sheet is of the assets with the liabilities, and we have other lectures that are going to explain what accountants mean when they say asset, what accountants mean when they say liabilities. So those items that are presented on the balance sheet are calculated in accordance with the accounting rules we've talked about before, the GAAP. So you may have different opinions on whether something's an asset or not. The thing to know about a balance sheet, a couple of fun facts, is that there are two double underlined numbers on every balance sheet, and they are the total of the assets and the totals of the liability and equity added together. Those two numbers have to be precisely and exactly the same. Otherwise, the balance sheet doesn't balance. And as you can probably tell from the word balance sheet, it's supposed to balance. So you always look at the balance sheet's two double underlined numbers first to make sure it balances. Because if it doesn't, you don't need to waste any more time looking at it because it is, in fact, wrong. The balance sheet also divides your assets and liabilities into categories. Assets are separate, of course, from liabilities and equity, but also within the asset category, you're going to show your cash separate from receivables, separate from inventory, and we further divide them up into current and long-term. A current asset is going to turn into cash within a year. So if your accounts receivable, which are the amounts that are owing to you from your customers, cannot be turned into cash within a year, they don't deserve to be in the current category on your balance sheet. They don't meet the criteria. They could be a long-term asset if you think you're going to get the money, but you're not going to get it till a year has gone by. Or they could be not an asset, which means they're not hanging out on the balance sheet, they're on the income statement. We present these numbers in the order of their liquidity, which is a stuck-up way of saying we put the things that turn into cash first on the page, then as they become less and less quick to turn into cash, they're further down the page. So, an example, cash is first because it's already cash. Accounts receivable comes next because in 30 days your accounts receivable are all supposed to turn into cash because those are your terms, right? Pause for humor. If you are not collecting your receivables, as I've said, in a year, then they don't go in this category at all. And then you've got inventory. First of all, you have to find someone to buy your inventory, then you have to collect the money. So inventory is 2 steps away from being cash, so it's further down on the balance sheet. Okay? So if you take a look at this financial statement, this balance sheet, we have this year numbers and we have last year numbers. That's to help you look across the line and see if the results are getting better or not. Anytime you can have a comparative financial statement, you've got more information than if you just have 1 year. And as you can see, we've got double underlined numbers under assets and under liabilities and equity for both years, and both years have to balance. So this particular business, you'll see we've got a list of current assets, cash, receivables, inventory. Then we have fixed assets. Fixed assets are things you're using in your business that are not for sale, like your vehicle, your computer, your land, your buildings. These are a different kind of assets than the monetary assets, which you see, cash, receivables, and inventory. These are assets you're using, you're not selling. And some businesses have intangible assets, as you see on this balance sheet, which are things like trademarks, copyright, goodwill, items that you can't really put your hands around, but you're using them in the business. And again, we have more lectures on that. Following the asset, you see the liabilities. Liabilities are listed in order of liquidity as well. You've got your accounts payable, which once again you're supposed to pay in 30 days. So they have to be paid fairly soon. Loans are shown, the portion that has to be paid within the year is shown in the current part. The parts that are going to be paid within a time period that's longer than a year are shown as long-term. So you've got 2 different categorizations there. You will see that there's a total under current assets and a total under current liabilities. This is going to be important to you later when we're calculating ratios current ratios and quick ratios about comparing the amount of current assets and current liabilities, but you have that yet to look forward to. On the bottom of the balance sheet, we see the equity, which you can tell is a residual. It is the amount you get when you subtract the liabilities from the assets. It is also the amount that you're going to see on the income statement. That retained earnings number is calculated based on the amount of money the business has made since it was born, less any dividends it's paid out. So it's calculated on the income statement, but it's needed on the balance sheet to balance the balance sheet. So this lecture has been about the basics of the balance sheet, the assets, the liabilities, and the equity. What you find out when you look at this balance sheet is whether you have more assets than liabilities calculated using the accounting rules. That is the entire purpose of the balance sheet. Thank you.